Section 1. The fundamental engine, supply and demand. At the core of every cryptocurrency's price movement lies the law of supply and demand. Simple in theory, this force governs the market's unpredictable tides. When buyers outnumber sellers at the current price, the market must rise to a new equilibrium. Conversely, excess sell pressure pushes price down. This push-pull is the engine behind every pump and every dump. A continuous contest between acquisition and disposal sets value moment to moment. Consider Bitcoin as a prime example of supply mechanics. Only 21 million will ever exist. A finite, predictable issuance schedule creates structural scarcity. Halvings reduce new supply. If demand holds or grows, value perception strengthens. Shrinking incoming supply plus steady or rising demand pressures price upward. Demand can surge with institutional adoption or corporate treasury buys, or waves of retail investors seeking a hedge. Read the battle on charts, price and volume together. Section 2. The human element, news, narratives, emotion. Beyond cold mechanics, psychology profoundly shapes crypto. News and narratives can ignite explosive rallies or trigger devastating crashes within hours. A favorable ruling or big-name partnership can flip sentiment instantly. Buy pressure surges as traders try to front-run the move, FOMO takes hold. Hacks, security flaws, or a looming crackdown spread faster. Classic FUD. A small dip can escalate as fearful traders liquidate, sell walls build, and price overshoots fundamentals. Viral narratives, an Ethereum killer or a meme coin, can drive demand far beyond utility. Charts paint the drama. Euphoric spikes and panic sell-offs. Sentiment tools scanning headlines and posts quantify fear and euphoria, measurable yet volatile forces. Section 3. Leverage turns small moves into dramatic swings. Borrowed capital lets $1,000 control $10,000 of Bitcoin at 10 times leverage. A 5% rise becomes 50% profit, and losses scale the same. If price drops toward collateral, exchanges auto-close positions to prevent debt, liquidation. Forced sales add sudden supply, pushing price lower. First liquidations trigger the next tier, compounding sell pressure, a long squeeze. The inverse, short squeezes, rip upward as shorts are forced to cover. Watch open interest. Total outstanding derivative value. A plunge with massive sell volume and collapsing open interest is the classic liquidation signature. A mechanical loop that feeds on itself. Market structure shapes stability. Liquidity is the ease of trading without moving price. Deep books absorb trades. It takes enormous capital to shift BTC or ETH. Depth acts like a volatility damper. Newer altcoins often trade in thin books, where small buys spike price and small sells crash it. Spikes of hundreds of percent can unwind just as fast. Whales hold large supplies and can move markets, and exchange inflow often foreshadows sell pressure. Conversely, stablecoin inflows followed by big buys signal accumulation and rapid pushes higher. On-chain watchers track large transfers and react, amplifying moves in illiquid names. A few big players in a thin market can engineer calculated pumps and sudden dumps. In crypto, technology is not a feature. It's the foundation of value. Significant updates and upgrades can be fundamental price drivers. When a chain gets faster, cheaper, and more secure, utility rises, attracting users and developers. Greater utility boosts organic demand for the native token. The Ethereum merge showcased how narratives around major upgrades can drive momentum and perceived value. Conversely, failures and exploits destroy confidence and price, sometimes overnight. In a trust-first market, one bug can erase billions. Developer activity can foreshadow upgrades and ecosystem health. Rising on-chain usage after upgrades shows technology translating into real demand and, ultimately, price. Though crypto feels self-contained, it's tethered to the global economy. Rates, inflation, and traditional markets influence digital asset prices. Aggressive hikes drained liquidity, turning investors risk-averse and sending crypto into a prolonged downturn. Crypto often moved with growth stocks in that period. Today, the narrative has evolved, with cooling inflation and an easing stance rekindling risk appetite. Risk assets have responded as capital rotates back to growth. Pumps and dumps aren't random. They're the confluence of supply and demand, news and emotion, leverage and liquidations, market structure and whales, technology and macro. To understand the market, watch the charts, follow the news, and never forget the bigger economic picture.